What do a quiet mathematician who once cracked enemy codes and a grandfatherly businessman from Omaha have in common? Two of the most successful investing records in history, but their styles couldn't be more different. Today, we're diving into the fascinating contrast between Jim Simons, the quant king, and Warren Buffett, the Oracle of Omaha. Two billionaires, two philosophies, but only one question. Who's the better investor? Let's start with a quick introduction. Jim Simons, born in 1938 and died in 2024. Mathematician, codebreaker, and founder of the Medallion Fund, one of the most secretive and profitable hedge funds in the world. His weapon of choice? Algorithms, data, and machine learning. Warren Buffett, born in 1930, started investing at just 10 years old. He took over Berkshire Hathaway in 1965 and invested in a portfolio of iconic companies: Apple, Coca-Cola, American Express, and many more. Buffett's edge? Patience, discipline, deep fundamental analysis, and compounding. Two legends. But their paths? Total opposites. Simons doesn't care about balance sheets or earnings calls. Instead, he uses math to uncover tiny inefficiencies in markets and trades them in milliseconds or up to just a few days. Buffett? He reads annual reports, not algorithms. He looks for companies he understands, buys them below intrinsic value, and holds them for decades. He once said, "Our favorite holding period is forever." Simons aims for precision through complexity. Buffett seeks wisdom through simplicity. Simons' approach is cold, systematic, and data-driven. He hires physicists, not MBAs. He feeds data from markets, weather, even satellite images into models. His Medallion Fund trades across everything: stocks, bonds, currencies, commodities. Buffett's strategy is warm and intuitive. He invests in businesses, not just stocks. He avoids tech unless he truly gets it. He believes in the margin of safety, buying companies below what they're really worth. Ready for the jaw-dropping part? Let's look at facts and performance. Simons' Medallion Fund returned 66% annually, before fees, between 1988 and 2021. That's over $100 billion in profits. However, assets under management was capped at $10 billion USD, thus compounding was impossible. Buffett's Berkshire Hathaway has averaged almost 20% annually since 1965. Lower? Yes, but over 8 decades, compounding at that rate turns a few thousand into hundreds of billions. So, Simons wins on raw returns. Buffett wins on longevity, accessibility, and compounding. Anyone can follow his playbook, at least theoretically. But here's the twist. Simons' strategy? Unreplicable. It relies on complex, evolving models, leverage, and secrecy. Retail investors? Not a chance. Buffett's approach? Transparent and teachable. You can start reading his shareholder letters today and apply his lessons tomorrow. In Simons' world, emotion is a liability. In Buffett's world, judgment is everything. Jim Simons revolutionized quantitative finance. He changed how Wall Street thinks about data and probabilities. Buffett redefined value investing and, more importantly, democratized it. His letters, interviews, and philanthropy have made him a household name, not just a billionaire. And he leaves behind a fantastic legacy when he retires at the end of 2025, aged 95. Both inspired millions. Both changed finance, but in very different ways. However, both leaves behind a positive legacy. So, who's the better investor? If you want astronomical returns and cutting-edge science, Simons is your guy. But if you want a strategy you can actually follow and wealth that compounds with time, Buffett might be the better role model. As Simons once said, there will always be a place for Buffett's style. And Buffett? He's acknowledged the power of data-driven strategies, even if they're not his style. Maybe we don't need a winner. Maybe the lesson is this: there's no single path to success, just one that fits your strengths. Jim Simons, Warren Buffett, two titans of investing, One data-driven, one gut-driven, and both, in their own way, unmatched. Which one inspires you more? Let us know in the comments. And don't forget to like, subscribe, and share this with your fellow finance nerds.